For all the talk about runaway inflation over these last many months,
the governor of the Bank of Canada says he intends to move as forcefully as needed to fight inflation.
Hey everyone, welcome back to Mark Loeffler Experience. Today we're talking interest rates. Interest rates, what they're doing, where they're going, what that means for you, what that means for the economy, what that means for us as real estate investors. And as always, this video is brought to you by Mark Loeffler Real Estate Services. If you're looking to buy a home, sell a home, or invest in real estate, please do reach out to us. We are in that business and we'd love to help you. So what does this mean? So as of today, this morning, the Bank of Canada doubled its overnight rates, right? This is the largest increase that they've done in 22 years. Half a point. Usually they're raising a quarter point at a time from the Bank of Canada. We expect it from the feds in the States as well, obviously. Interest rates are going up, right? We know this. If you've done if you've done a variable rate mortgage, basically your mortgage just increased. So my mortgage has gone up. I have variable rates on most things that I own, and my mortgage has gone up, basically almost not double, but it's gone up significantly, yet it's still, most of them are still below 2% right now. In my mind, anything less than 3% is still, anything less than 4% is still free money in my opinion, because I'm probably going to make a better return than what I'm paying. But anyways, that's besides the point right now. What's really going on? Well, there's a couple things going on with interest rates right now. So fixed rates are going up, right? We've all noticed that most fixed rates are over 4% right now. We haven't seen that for a long time. Why is that? Well, basically the Bank of Canada has stopped buying their own government bonds. So they were artificially lowering the cost of interest so more money poured out into the economy, and more money did pour out into the economy. We saw that obviously in the real estate market, the used car market, the new car market. And then there was a cluster of supply chain issues that then caused things not to be available. So what does this do, right? End of the day, what does this do? Well, it makes everything more expensive because most people are not buying things cash, right? Most people, if they're out buying a car, they're going to finance it. They're buying a house, they're getting a mortgage. I'll be honest, I've been looking at watches for a while, and I can't bring myself to pay the cost of what people are charging for these watches. And why? And I keep thinking of it like, why are these things going up so much in value, other than the fact that money is so cheap right now that people are borrowing to buy these types of things, right? Like they're not. Most people are probably not using cash to buy these things. So therefore, the value of these assets are going up because, again, people are using the free money that they're getting given from the bank, the government, whoever, to go purchase these things. So I'm hoping, because I do want to watch at some point. I'd like a nice watch. I mean, comment down below what you own or what I should buy or what you could see me in. Just keep in mind that I am German, which means it's a close relative to Dutch, if you know what I mean. But this is what it does, right? So people then look at their cost to borrow, to buy that car, or to finance that trip, or whatever they're looking to do, home renovation, and they're going to say, oh, that's going to be more expensive than I want to pay, and they're going to cut back. Increasing these rates, which is basically, this only affects if you have a variable rate mortgage or if you have a line of credit. And those are a couple tools that most people are using to, again, invest or buy or whatever. And this affects like how much you're going to pay monthly. So if you have a bunch of money on there, you're going to have less free income to go out and do different things with. And that's what this comes down to, is they're cutting off the money supply. So you have to look at this like, okay, we're in a car race and we're flying that. So we come out of a corner, let's call that corner COVID, and they just pump the gas, like your foot to the floor gas. They're throwing in nitrous oxide. They're doing whatever they can to, like, that 100-mile-an-hour car. They push that 100-mile-an-hour car to 200 miles an hour. Like they just put whatever they could in to make that the car or the economy go so fast, which probably averted a recession or more of a downturn, less of a downturn than what we had. And as you saw, I mean, you saw that in the stock market, it just went and then right back up like 2-3 weeks later, right? And then we've had a steady climb, and now we're, kind of leveling off, coming down. This is them getting to the corner, and they're like, woo, we can't take this corner at 200 miles an hour in this 100-mile-an-hour car. We need to slam on the brakes. Like we are like, and here's the thing. Over the last 2 years during COVID and all this money printing and going so fast, they haven't improved the braking system in the car. So they are, we might go off and hit the corner, which, might go off and hit the wall. By doing all this type of stuff and at the speed that they're doing it, they didn't, it doesn't feel like we're coming in for a soft landing. This feels like we're going to have a hard impact. This may lead to a bit of a recession. Let's talk about what's going on. Jobs, great guns, right? You want a job, you have a job. You can basically dictate what you want to make in reason. We still have supply chain issues. Obviously, China has shut down some areas again. We have, shipping issues. These things are still real out there. If we decrease demand for some of these items, some of that backlog and, issues will naturally peter itself out. So this is what they're really hoping to do over the last 2 years. They have printed so much money and gone into so much debt. A lot of people have too. Government's going to clam up. People are going to clam up and stop spending, which is going to lead us into a recession. So, you know what? I keep saying this. Hey, we're living in interesting times. We definitely are living in interesting times. But one of the unintended consequences that higher rates have is that people are still going to move to Canada. I know there's people leaving. To be honest with you, they're not my customer, right? My customer is typically a tenant. Maybe they're newer to Canada. When people come to Canada for the first 2 to 3 to 5 years, they rent before they buy, right? They want to figure out what area they want to be in. They want to make sure they have a solidified job, so they're going to rent. And there's a whole class of renters. And what happens when interest rates go up? Well, less people are buying homes. We're already seeing that, right? We saw sales value drop 40% year over year in March in Ontario. And those people are still living in Ontario, southwestern Ontario. They have jobs, they have families. They're going to live somewhere. What are they going to do? They're going to rent. Yes. So we're going to get more renters. And, are people going to build if they think the economy is going to go down? No. So that means there's going to be more people vying for the same rentals. And a lot of people got out of the rental game in the last 2 years if they had houses, right? Rents are going to go up. At the end of the day, rents are going to go up with the interest rates. So if you have rental property right now, you're going to do well over the next couple of years. Obviously, inflation is going to still be with us. I mean, I see it, like another 6 to 12 months? They're going to try to break the back of this thing, though. They are going to work hard, and that's going to lead us coming into a hard crash, and that's my prediction on that. All right, everybody, you guys have a great day. Have a great Easter weekend if you guys celebrate, and we will see you next week.